the federal R&D tax credit has not been extended. As we see with the new change, credit percentage is now 6.5%. And one thing about the credit, the Illinois Department of Commerce and Economic Opportunity, they feel this is a great for the state of Illinois, primarily because it creates the much-needed jobs that they need. But the one thing I think that we can, one thing that is very interesting about this is that Illinois has one of the highest concentrations of research institutions in the country, and that includes more than 440 corporate R&D facilities. So I mean that I think is an indication that Illinois wants to be an R&D center, and they want to and they want to enhance, and they want to basically show that R&D is much required within the Illinois as well as within the United States itself. So I have to offer to them to actually extend it through 12/31/2010 without the federal being extended. So if we go to the next slide here, one thing we want to talk about is some differences between the Illinois R&D credit and the federal R&D credit. Now, as we look at both of them, the federal allows both the regular credit or ASC, and most either do one of those two. And the expenses for both of them are the same. The Section 41 expenses for wages, supplies, and contract research. You look at the federal, the regular, if you're using the regular credit, you're going back to that base period of 83 through 89, or you're going to use START rules, which are going to be slightly different. Federal allows ASC. Illinois, when you look at they're using the 3 tax years of the qualified expenses preceding that determination tax year. From a federal standpoint, for gross receipts, you're using your average 4-year tax years, and then for ASC it's not required. And then for Illinois, the gross receipts are not required. One thing also with the state credit for Illinois, it's not dependent upon the federal credit. As we spoke, as I mentioned before, the credit's at 6.5% compared to the regular for federal is at 20% or 13% if 280C election. And also the Illinois R&D tax credit is not refundable, like some other states are refundable. When you look at some of the documentation that's required for the Illinois, they don't impose any specific substantiation requirements, but some states expressly or implicitly adopt the general documentation requirements of the federal research tax credit. So generally, those requirements say that the taxpayer is to keep sufficient records to substantiate its research tax credit. And I think for purposes of Illinois R&D tax credits, if you follow the federal documentation requirements, that should suffice for supporting the Illinois credit if it goes to audit. Okay, we can go to the next slide, and we can talk a little bit about the Iowa R&D tax credits. One thing we could talk about is this alternative energy projects. Effective July 1st of 2009, an additional $3 million in research activities credits is available for expenses related to development and deployment of innovative renewable energy generation components manufactured or assembled in Iowa. But keep in mind, these expenses are not eligible for the federal R&D credit or the Iowa supplemental research credit. And then also, a business that is eligible for this must be approved by the Department of Economic Development after July 1st, 2009. Now, you might ask yourself, what are some of the components for a renewable energy generation project? And generally, those are probably your wind turbines that are manufactured in Iowa. That would be an example of a renewable energy component that's manufactured or assembled in Iowa. Now, if we go to the supplemental research credit, now that research, that's a new one also. That's a new one here with Iowa. And that is research activities conducted by eligible businesses under the new Jobs and Income Program, or the new Capital Investment Program, or the High Quality Job Program, or the Enterprise Zone Program. The amount of that supplemental activities is shown in the contract that's entered between the eligible business and the Iowa Department of Economic. So projects that are approved after July 1st, 2010, The supplemental research credit is 10% for those taxpayers with gross revenues of 20 million or less, and for those with 20 million or more gross revenues, that supplemental credit would be 3%. And that credit may be doubled up to 13% when that business participates in a state's high-quality jobs creation program or the enterprise zone program. And also with Iowa, again, this is one of the few states that offers a refundable tax credit. So companies that can earn refundable tax credits that may be paid directly to cash to the company once its tax liabilities are met. And also, it's also great for companies who haven't filed a credit historically. They can go back and file amended returns to take that credit, but keep in mind there's a 3-year statute of limitation. And
I'll comment on something real quick, Dave, is that, that the supplemental research credit, that needs to go through the Department of Economic Development. So it's not something that you just put down. If you're in the program, you actually have to get, the department will actually give you how much you can put down on your form. So you still have to get an approval process. You can still claim the regular credit, and then the supplemental credit, if you're in one of those programs, they will qualify you to gain some additional credit.
Okay. And then this next slide is really, again, just a comparison between the Iowa credits and the federal credits. And probably the most important thing, or one of the keys, is that that innovative renewable energy cost, it's not eligible for the federal credit, but it is eligible for the supplemental credit, or it is eligible for the Iowa Research Activities credit. Base period, not required. Gross receipts, not required. The credit, 6.5%. And as we spoke upon before, the gross revenues has to be under 20 million for the 10% and over 20 million for the 3%. And as I mentioned, it's also a refundable tax credit, and obviously the federal credit is not.
And Iowa does, they do have an alternate, I think, Dave kind of has it pointed out there, the alternative credit. So the regular credit under Iowa is dependent on the federal credit, but the AIC isn't. So, when we say yes, just kind of, keep that distinction. We're just kind of really comparing the regular credits, making sure if they're federal credit or not.
And again, from a documentation standpoint, even to support the credit, federal documentation should suffice. But again, also keep in mind that the contract that's entered between the company and the Department of Economic Development that documents the approved credit should be retained for audit purposes, your own records.
And Dave, I'll pause you for a second. Just for anybody who's kind of joined us in process, we've kind of started the webinar. We've gone through some of the states, already. If you have questions, there's the chat that's kind of open. If you want to chime in through the conference call, you can do that as well. We just ask if you kind of mute your line if you're on the conference call portion. The other thing for some folks who might just be listening to it online, you'll have to kind of submit your questions through the chat. But if you're on the actual call line, just make sure you mute your line so we don't get any feedback or typing or chit-chat or anything like that. Okay? All right, Dave, continue on.
Let's head to Louisiana. Okay, so in 2009 here, the Louisiana, for 2009 tax year, the Louisiana R&D Tax Credit is a refundable one, and basically companies that have the Louisiana-based qualified research expenses are eligible for that credit. Any taxpayer who claims for the taxable year for a federal income tax credit for the research activities are qualified to do that. Begin with the 2009 tax year, any taxpayer who employs up to 50%, 50 Louisiana residents and incurs qualified research expenses for that taxable year is also eligible for the credit without having to claim a federal income tax credit. The application process for this is somewhat lengthy. I didn't provide all the steps, but I can kind of go over them. But for approval of tax credit, the taxpayer must complete certain steps, and submit a signed application with a $250 fee for documentation. And like I said, the application process is, again, somewhat lengthy. It requires the taxpayers to submit a copy of their SBI or STTR grant. It also requires approval of the LED Louisiana Economic Development showing tax credit certificate or letter issued to the taxpayer stating the amount of the tax credits allowed. And basically, when that's done, that certificate must be attached to any Louisiana return when the credit is taken. So again, it's a very lengthy process, but considering that's a refundable credit, it's probably well worth to go through that process to get that refundable credit.
Yeah, and and on that Louisiana, the application process, it's different than if you have kind of a different state where all you have is the credit form. Really, you're going through that application process first. There's really no form per se that you just you're getting that certificate, and it kind of related. Louisiana was one of the first ones to kind of do those film credits. So they're kind of modeling at this refundable portion for their R&D credit, similar to how they do their film credits, where they give you a certificate. The other interesting thing is about that if you received grant money, you actually can get a credit for the Louisiana activities, which, typically if you're receiving grant money under the federal, it usually doesn't qualify. So that's kind of another interesting point to note. So
we get to the next slide again. This is, again, what we're trying to do, comparison between the federal and the Louisiana credits. And again, as we go through it, your typical wage, supplies, and contract research expenses qualifying under Section 41 obtain both the Louisiana and federal. For the Louisiana, there is no base period. There is no gross receipts required. And again, as we talked about, the credit is 8% if you employ more than 100 employees, 20% if it's between 50 and 99, and then also for 40% for taxpayers with less than 50 employees, and it's R&D expenditures only that the percentage would be. And as we spoke before, it is a refundable credit, which is one of a few states that does that. And again, from a documentation standpoint, you could probably follow the federal in terms of documenting the qualified research expenses, and that should suffice for Louisiana. Okay. And now we go to New York. So this, the New YorkExcelsior Jobs Program, that was signed into law by David Patterson in June of 2010, and that was basically to replace the Empire Zone program as of June 30th, 2010. But one thing we need to indicate that, the Empire Zone program, it will no longer accept new participants after June 30th, 2010, and the benefits will stay in effect for those that are already in that program as long as they remain in good standing. But businesses will be able to start enrolling in this new Excelsior program on July 1st, but they can only be enrolled in one of the two benefit programs. Some of the main features of the Excelsior Jobs Program is that it's the majority, they work to include tax credit firms in those industries that create and maintain new jobs, or to make a substantial new investment in New York for 5 years, which, unlike in the past, are refundable. And those tax credits now include the Excelsior New Jobs Tax Credit between $2,500 and $5,000 per new job to cover a portion of the associated payroll costs. The Excelsior Investment Tax Credit valued at 2% of the total qualified investments. And then the third is that Excelsior Research and Development Tax Credit, providing a 10% credit for new investment based on a federal research and development credit. And fourth is the Excelsior Real Property Tax Credit, valued at 50% in the first year, decreasing to 10% in the fifth year for regionally significant projects or businesses targeted industries which locate to distressed areas within New York. Okay, so we go to the next slide here. Again, from the expense standpoint for the wages, supplies, and contract research, again, both follow Section 41. For New York, base period and gross receipts are dependent upon the federal. The state credit is dependent upon federal calculation, and the credit's at 10%, and the credit is refundable, and it's equal to 10% of the federal R&D credit for the portion attributable to the R&D expected in the state of New York.
And just on the New York credit, this is actually a pretty big deal because New York did not have a credit like this before. We're talking research credits, excuse me, research credits that that they had before. So this is a pretty big deal. And New York has a lot of businesses in that state, so it's a pretty big deal for them, kind of offering this up and kind of attractive for the 2010 going.
And also from a substantiation of the credit itself, and again, New York doesn't have express documentation process or procedures, but we rely upon the general guidelines of the federal documentation for the federal R&D tax credit. That should suffice for New York credit and for audit purposes as well. Now we can go over to the Minnesota tax credit. So here in April of 2010, the governor signed into new legislation that changed the research and development tax credit, which will benefit eligible manufacturers across the state. And some of the major changes to the credit include, for beginning after 12/31/2009, partners in a partnership and shareholders in an S corporation may now take the R&D credit, whereas previously only the C corporations could take the credit. One other big change is the credit is now equal to 10%, which was 5% of the first $2 million of excess, if any, of the qualified research expenses, and 2.5% of all such excess expenses over $2 million, over the base amount there. Again, what's also great about the Minnesota one, the credit for taxable years is refundable, where previously it was not refundable. So we can see more states seem to be going in that direction, trying to grant refundable credits. One of the biggest things about this Minnesota credit here too is that companies that have had losses and have never taken the credit can now take advantage of the credit in 2010 to obtain a refund. So if we kind of look at the differences here between the Minnesota and federal credits, again, we can go back to the wages, supplies, and contract research, again, all Section 41. The base period, is very comparable between the Minnesota and federal. But one thing I want to point out is that the gross receipts relies upon the Minnesota sales or receipts that are used to apportion income, which is a little different than the gross receipts requirements for the federal. State credit is not dependent upon the federal calculation, and the credit is refundable. Going back to the credit percentage, 10% of the first $2 million, and then 2.5% on the excess over the $2 million. Going back to some of the other things in terms of the documentation, again, Minnesota doesn't have any requirements from a documentation standpoint, but if we can follow the federal documentation standards, and we feel that will suffice for Minnesota. One thing, Form 6765 is required to be attached to the Minnesota credit when you file your state return. We could hit the California one.
I'll just pause you for a second, Dave. Any questions? Anything? Anybody want to chime in? On any of the states? Again, we kind of picked some of these states. So I know it's not covering all the states and all the research credits that are out there, but some of the things that have changed. And again, for those who have kind of joined us midstream, kind of put your line on mute. If you have questions, you can use the chat. You can use the phone. We will, if you want the copy of the slides, go ahead and kind of send an email to us. I think everybody's seen kind of, our administrator at cfoserv.com. I'll also just post our emails here in the chat to everybody. But if, no further questions, I guess we'll go on to California.
Okay. So the California R&D credit, taxpayer qualifies for that for incurring research expenses while conducting qualified research in California. They receive 15% of the excess of current year research expenditures over the computed base amount. And what's nice about California is that to claim the California research expenditures credit, you do not have to claim the federal research credit. California, their law generally conforms to the federal research credit that was enacted under the Small Business Jobs Protection Act, but they do have some modifications. And I can go, a couple of those modifications are, again, as we spoke, after 1/1, the credit is now 15%. California does conform to the alternative income credit, except for some differences in the rates. So for taxable years after 1/1, the rates are 1.49%, 1.98, and 2.48. The credit cannot be carried back to California, and California does not generally conform to the federal definition of fresh receipts. And also, the termination dates provided under federal law do not apply. So, for currently, there is no California termination date credit. So, if we go to the next slide and look at the comparison between the California and the federal credits, again, we can see from a wage supplied contract research, Section 41 applies for both. One thing that's probably the biggest difference between the federal and the California credit is that ASC is not recognized by the state of California. And as before, the state credit is not dependent upon the federal credit, and the credit is not refundable. And for documentation standpoint, California, like the federal, says that the taxpayer must retain records in a sufficient usable form and detail substantiate the expenditures that qualify for the credit. Again, what they're saying from a contemporaneous documentation, again, follows federal, that documentation or support should be from the time period of the underlying transaction, services, or activities, while the state can provide taxpayers with some degree of flexibility to substantiate the credit. This flexibility does not relieve the obligation to keep and provide a record of the qualified research expenditures by the taxpayer. Again, very similar to the federal guidelines.
Yeah, and I'll comment a little bit on California. California with not, they don't have a termination date. That's a good thing because obviously their credit is not going to expire. And some of you probably have some decent operations in California, and sometimes it can be a pretty substantial amount of credit next to the federal credit. But the state of California does, they probably out of all the states probably look at their research credit the most. And that's, just kind of from our take of dealing with some of the states on the research credit. So they're pretty knowledgeable about those things. So they actually will kind of, ask some questions you would only think the federal, the IRS would ask about the research credit. But California's research credit has been around for it's a long time. But it's a big state, has a lot of research in there, so it's big for California to kind of still have its credit out there and not be dependent on the federal credit. So that's pretty important.
Okay. So now we can go to Nebraska here. So, basically with Nebraska, with the Nebraska Advanced Research and Development Act that was created, research tax credit is available for tax years beginning after 1/1/06. And basically companies that incur R&D expenditures in Nebraska are eligible for the credit. One thing we want to, keep in mind here with this is that, the credit is at 50% of the federal tax credit, and this tax credit may be used to obtain a refund of sales and use taxes paid or as a refundable income tax credit. Companies that make expenditures in research and experimental activities on the campus of a college or university in Nebraska or facility in Nebraska owned by a college or university are allowed a tax credit up to or equal to 35% of the federal credit instead of the usual 15%. And probably one of the most important points with the Nebraska R&D tax credit is this fourth bullet point, where the Nebraska Department of Revenue, they've recognized that the legislation related to the E-Verify, if followed, word for word, would effectively render most states' incentive programs, void. But under examination, they've agreed to examine each year separately and work with each taxpayers in certain situations. There is no established procedure for the review, which means that it's a case-by-case review of each for each taxpayer. And the E-Verify requirements, basically, what that is, it requires that the taxpayer to do E-Verify or the Federal Electronic Verification Program of employment eligibility of new hired employees within Nebraska, and that's key for this credit to be sustained or even to be approved.
Yeah, E-Verify, just to even give a little more context for everybody who might not be familiar with it. It's actually run by the Homeland Security, and what it is, it's kind of a place to verify employees. And Nebraska wanted to make sure that, if anybody was getting incentives, that they were going through this program to verify employees. And so the way the legislation was written, it was very stringent. Dave kind of pointed out. So, so what happened is it kind of caught some companies off guard, and he kind of raised it up to the Department of Revenue and said, hey, we understand what you're trying to do, but the way, if you read it, it can kind of get some people, behind the eight ball, and they still should get those incentives. And they're asking for you to E-Verify all new employees, not just employees that are new, that qualify under the research credit. So you can have, a lot of employees. So it's just one of those, obviously with a lot of state credits, you have to kind of, there's some nuances. I know E-Verify is in other state programs that are out there where they want to give you some other incentives, but this one specifically on the form, it asks you for your E-Verify number and asks you if you have E-Verified employees.
Okay, we can go to the last slide here, that shows our table of the differences or similarities. Again, from a wage supplies and contract fees, you see that both follow Section 41 from a base period applicable. Gross receipts is not applicable. For state credit, it's dependent upon that federal calculation. The credit's 15%, and it is a refundable credit. Again, we go back to the documentation. Again, Nebraska doesn't especially indicate what the requirements are. But again, generally, if you follow your documentation and records attention for the federal credit, that should suffice for the Nebraska credit as well. And that's all I have for Nebraska.
Yeah, so that kind of covers all of our slides. We try to keep our webinars kind of, short and sweet. I know that there's a lot of webinars, a lot of, things that are out there that you guys can get, information to. We want to kind of make sure that we're talking about research credits, really that's our specialty, as everybody knows. But just wanted to talk about those things specific to those states. A couple things to kind of point out in summary is, I know we mentioned a bunch of refundable states that are out there, Nebraska being one, Iowa being one, Minnesota being another, Louisiana. That's 4 states that are refundable, and that's that's a cash benefit that's great for some companies. They don't have state liability depending on what's going on in that state. But if you can get some refunds, that would be good. But the other thing to kind of watch out for is that where the state credits, like we look at Nebraska, well, it's dependent upon the federal calculation. So I know that the next question always is, when is the R&D credit going to get extended? And it's going to get extended. Our belief is it should happen in the lame duck here. That's kind of a short window, but everybody believes it's the right thing to do. It's just getting it to, getting past some of the politics that are kind of happening in Washington right now. But you just do have to watch is some of the credits that are not dependent on the federal credit, you can kind of proceed as planned. You can still plan normally for those, but for sake of example, Nebraska, if you're planning on Nebraska, obviously you can't kind of put that into your, full plan yet because obviously it depends on the federal credit. So it's kind of a catch-22. Yes, Nebraska or Iowa or some of the other states are still active. Their credits are still active, but if there's no federal credit, then essentially they don't have a credit. So just to think about those things as you guys are planning for your 2010 and further into 2011. The last thing I want to do is kind of open up a poll. If nobody has any other questions about the state credits, I'm going to open up a poll, and these are just some ideas that we're having for our next webinar, which we'll probably do somewhere at the end of the first quarter or so. I think that's when we kind of do our. So I'll open up this poll. I'll slide it up here. If everybody wants to just take a second and click, I'll kind of go through the selection. So audit considerations. Audit considerations are what do we see? Be it CFO Services. When we work with our clients and we help them through audit, what are the things that we're seeing the IRS is kind of asking for, getting to, and audit considerations. Process of experimentation, how it applies, that's more specific to getting to the rules, the code. Okay, when we're talking process of experimentation, what do we need to make sure that we're demonstrating through our documentation or demonstrating to the IRS of things that are there. The RCM tool demo, we did this one back in May, but I don't know if that'd be one to do again. We kind of have a, kind of our tool that helps some of our clients, gather some of their documentation, and we kind of use that in providing our services. We can kind of, go through that and give everybody a little more insight on how we use that. And then lastly, supervisor support and substantiation, obviously trying to play on the S's there. That is supervisor activities, support activities, and how do we substantiate that? Everybody can see my direct involvement, my engineers, my researchers, those types of people. That's really easy to identify. But the supervisor and support, who are those people? What is kind of, what is kind of really shouldn't be included, and what are some of the things you really have to have? There is some subjectivity. It's case-by-case facts and circumstances. And what are the things you need to kind of substantiate that, or what do we get along the way that we do that? So if everybody kind of vote, I'll give it, another, 10 seconds. And as everybody's kind of voting on there. Again, if you want a copy of the slides, I posted our email out there in the chat, or you can send it to the administrator at cfoserv.com. We'll get you a copy of the slides. We also recorded the webinar, so if you want to listen to it again, if you guys, if anybody is dying to hear us speak about state research credits, it'll be on our website under our newsletter webinar section. Go ahead and listen to that. Other than that, we appreciate everybody getting on the webinar. Hopefully it was, a little bit educational for you. If you do have questions, give us a call. I think everybody has our contact information. You can get it from our website as well. But I appreciate everybody getting on the call, and hopefully we'll see you at our next webinar. Thanks, everybody.
Thank you.